All right, as Credit Suisse joins Silicon Valley and Signature on the list of troubled banks, the question is whether more will join them. Joining us now to talk about the banking crisis and the ripple effect in the market, senior markets commentator Mike Santoli and CNBC.com banking reporter Hugh Son with us in the studio. Hugh, let me begin with you. At root, fundamentally, what's the matter with Credit Suisse?
Okay, so Tyler, glad you asked.
Yes, it is me.
Yeah.
Yeah.
Investors have woken to the fear, to the increased risks they're building up the banking system as a result of moving from the regime where we had zero interest rate policy for about a decade into a more normalized environment. So you have basically the market sniffing out. You've had 3 banks fail here in the U.S. in the last week. Now you have the market essentially sniffing out
every bank.
Who could be next in the system? So there are some similarities. And if you look at Silicon Valley Bank, we know that on Thursday, $42 billion in deposits fled the bank in a single day. That's pretty dramatic. Now, we've also learned that with Credit Suisse, in the fourth quarter alone, they lost 110 billion Swiss francs in their deposits. So 37% of their entire deposit base evaporated in the fourth quarter. That was in the fourth quarter. Here we are in March. Some of those outflows have continued.
But this has been a notably slow-rolling debacle in the case of Credit Suisse. It's not like SVB, where one day everything seemed okay and the next it didn't. Here we've been watching Credit Suisse deteriorate.
Credit Suisse has been a known problem player. I would say that the tinder has been laid out, and now with the crash of these 3 banks in the U.S., certainly the fear of contagion has spread, and it really is the market essentially saying who's going to be next. And in Europe, they're the weakest of sort of a bad bunch, right? They've had risk management issues over the years. Their revenue has collapsed. Their costs are relatively sticky, so they're in a negative feedback loop at the moment. And, I've talked to sources, and one of the common things they'll say is, when the name of the country is in the name of your bank, you're probably going to get bailed out at some point.
Sure.
But that has not happened yet. And so there's concern of contagion from a collapse in this
Even, Mike, as we're showing, for instance, HSBC, which itself just came to the rescue of SVB's UK arm, buying them for £1. So this is not like you can paint everything with a broad brush here.
No, not at all. And honestly, I don't think there's a really satisfying answer to why now, why today, aside from that trigger being sort of pulled by the comments that, the Saudi bank would not add more to its holdings. And I think what it tells you is we're in an environment where you just try to pick out the slowest member of the herd because you have a fear that because rates are going up, because you do have lots of flows in motion in terms of deposits leaving, especially low-yielding accounts, you're getting penalized in a sense for the more sophisticated your customer base is and the more concentrated it is, the more vulnerable you are. That was the case with SVB. It's the case with the fears around First Republic to a degree. And it would theoretically be the case in terms of the wealth management clientele of Credit Suisse, where it's why do we stay when we could just go? That being said, I think we're just trading the shadows here. We're just sort of flinching because maybe there's something there. There's not an aggregate capital deficiency out there. There's not really some kind of trove of toxic assets we've never before been witness to, as there was in 07, 08, 09. What we have right here is government bond prices went down a lot last year. We knew that, right? And that's just sort of sitting on the books out there. So in that sense, maybe there's a slight comfort in the fact that we're not really waiting to unwind something that is a mystery. We're just sort of figuring out, whether these folks can stanch the deposit outflow.
Hugh, how do you react to that?
Yeah. So, one key thing is the news that sparked the sell-off in Credit Suisse today was Saudis saying, look, no mas, we're in for 10%. We can't go any further. That was known. That's a regulatory hurdle that they have. They could never have gone past 10%. So, understanding that tells you all that you need to know about this, which is it's about fear. It's about lack of confidence in the banking system, in that part of the world, and concerns that investors have with the risk in the banking system.
Yeah, I think that's an interesting way to put it. I mean, we've used the word contagion a good bit here. It seems like there may not be a classic credit contagion here, but there is a contagion of suspicion and fear, right?
Yeah, and that's based on how flighty are your deposit base. You know, and as Michael just pointed out, I mean, this is the wealth management deposit base of Credit Suisse. They haven't stuck around. They've voted with their feet, and they've moved.
Interesting point that Michael made. Michael, you said, earlier, a moment ago, it's been the more sophisticated customers who have been moving the fastest. Maybe that is always the case, but it's an interesting point. Go ahead, finish the thought there,
well,
and then we got to run.
As a matter of fact, a lot of the analysts have said, look, we like the banks that have a very fragmented, overwhelmingly retail deposit base, and a lot of these sort of southern regionals and things like that. And it's really just because the money just doesn't move in mass very efficiently, and there's some stickiness to just having your bank account where you get your payroll, direct deposited.
Got it. Mike, Hugh, thanks very much. Appreciate it.